Let's take a deep dive into the complex world of wealth disparities, stock ownership concentration, historical trends, central bank influence, and the impact of key turning points in our economic history. Firstly, when we talk about wealth disparities, it's staggering to see that the bottom 50% collectively holds just under $4 trillion, while the elite top 0.1% sits on a mind-boggling $0 trillion according to Federal Reserve data. That's a chasmic gap, and it raises questions about the fairness of our economic system. Now, let's look at stock ownership concentration. The top 10% holding approximately 92% of corporate equities and mutual fund shares is a stark indicator of wealth concentration. It essentially means that a small fraction of the population has a stranglehold on the majority of the stock market. Delving into historical stock ownership trends, a concerning pattern emerges. During crises like the Great Financial Crisis, the wealthy tend to sell off their stocks while small investors buy. This is a double-edged sword. The rich are able to protect their wealth, but it also means that the average investor is left holding the bag during market downturns. One factor contributing to this is the influence of central banks on the stock market. The idea that central bankers can sway market dynamics, contributing to a wealth transfer mechanism, is disconcerting. It raises questions about the fairness of the system and whether it's truly a level playing field for all investors. 1971 was a pivotal year. The United States left the gold standard, and since then, productivity has soared while average worker compensation has flatlined. This is a key turning point that set the stage for the growing wealth inequality we see today. The ability to print unlimited money after leaving the gold standard is another crucial aspect. This practice is linked to increased money supply, causing prices to rise. The consequence? Wealth concentration among government, contractors, and large corporations. It's a mechanism that seems to benefit the big players while leaving the average person grappling with the rising cost of living. Shifting our focus to wealth inequality trends, various charts and data paint a concerning picture. The detachment of real GDP per capita from real median weekly earnings post-1971 emphasizes a growing disparity. While the economy as a whole has been growing, the benefits aren't trickling down to the average worker. Now, let's talk about income disparities. Specific data highlights that after 1970, the income of the bottom 90% remained stagnant while the income of the top 1% skyrocketed. This isn't just about wealth, it's about the day-to-day livelihoods of ordinary people. In the realm of investing, recent trends show a bearish sentiment with a high ratio of insider selling. This is a warning sign for retail investors. The message here is clear: beware of the fear of missing out, FOMO, and avoid panic selling at market bottoms. It's a plea for caution and strategic thinking in the face of market volatility. Building on this cautionary note, there's a piece of advice against adopting a buy and hold forever strategy. The argument is that it's incomplete, and there are potential scenarios where individuals may need access to their investments during market downturns. It's a call for flexibility in investment strategies. Now, let's get to the root cause of wealth inequality. The core argument presented here is that wealth inequality is not the disease but a symptom. The root cause, according to this perspective, lies in government money printing and the actions of central banks. The beneficiaries? The biggest debt holders, government, contractors, and large corporations. In summary, these concerns paint a picture of a financial system that appears skewed towards the wealthy. From historical turning points to income and wealth disparities, the message is clear: there are structural issues in our economic system that need addressing. Whether it's the influence of central banks, the detachment of wages from productivity, or the concentration of wealth in the hands of a few, there's a call for a closer examination of the mechanisms driving these trends. As investors navigate these waters, the advice is to proceed with caution, be aware of market dynamics, and question the underlying causes of the disparities we see today. Please go ahead liking, subscribing, and sharing with friends to support our content. The information is for general purposes, Viewers should conduct research and consult professionals for financial decisions.